Hey, what's up, guys? Welcome to the VIP Financial Ed YouTube channel, where we help you go further, faster financially. I'm your host today, Michael Matthew. Guys, we've got a great video. We've got MC Laubscher back on the channel here today. If you have not seen videos with him on here before, we'll go ahead and drop that playlist below. If you have before, you're going to be excited to see him again today. MC is a complete expert in all things economy and really investing in general. So we love to have him on here as that kind of Swiss Army knife, to steal one of his phrases, if you will. He's the founder of Producer's Wealth. He's the creator of the Cashflow Ninja Podcast, and he's the author of the book, The 21 Best Cashflow Niches, that I've read. I personally recommend. Welcome back to the channel, MC. Thanks for being here.
Thank you so much for having me.
Yeah, absolutely. So I love this video today. We're just going to be talking about just some relevant topics. We're going to kind of rapid fire off some just some headlines and some topics, and I'd love to get your take on them. We can just kind of go back and forth and see where this video kind of ebbs and flows. This is going to be all things related to 2023, what it'll look like, projections, kind of some market analysis, what you plan on doing personally with your investing strategies. Let's go ahead and dive into that. So what are your plans? What are your targets? What are your personal financial goals for 2023, as much as you're comfortable sharing, of course?
Absolutely. Yeah. So I would say that, with my sports background, because I used to play at a pretty high level sports. So with my sports background, there's two sides of the ball, right? You have to play really, really good defense, and you have to play really good offense. And sometimes, especially when you're trying to win championships, most people have heard the cliche that, offense, a great offense might win you games, but great defense wins you championships. And I think when it comes to an investing strategy and mapping out a strategy in 2023, I think playing really good defense is a very good starting point. And that's where I'm building from. So I'm making sure that my defense and my strategy is set up properly, and I'm trying to see if I've got some blind spots in it. So what does that mean? So a big part of that is obviously tax strategy. Taxes are changing in 2023. A lot of people haven't quite grasped that yet, because not a lot of people have talked about it, but there's a lot of changes, especially for real estate investors and business owners that have equipment. So there's a lot of changes when it comes to taxes. So tax strategy is very, very important. Then it comes to asset protection, protecting your assets. And then also estate planning. There's a lot of changes coming down the line in the next couple of years with regards to estate planning. So having all those things in play, and first is where my focus is, and then from there I'm building protections into my wealth strategy further when it comes to capital allocations. So I'm much more heavier in cash, much more heavier in wealth insurance, which is the metals, and then I'm also still looking at cash flow opportunities, but very much more focused on the first two buckets, which is cash and metals, and then the cash flow opportunities. And then, of course, I'm always looking at speculative opportunities as far as a growth bucket or an allocation of capital for growth. But yeah, that's kind of how I'm approaching this. I'm making sure, especially in January, that my defenses are set up properly so I can play good defense in all the key areas, whether it is from a tax strategy, asset protection, or estate planning, or from just a capital allocation standpoint. And once you've got your defense set up really well, and you've eliminated a lot of the blind spots, because we all have them, and we will continue to have them, right? So you have to continue to evaluate your defenses. But once you do that, then you can focus on all the opportunities. In an environment where there is so much change, there is change happening at a speed which we haven't seen before, and it's not hyperbolic. I mean, the change in technology is literally something we haven't seen on this planet before. If you just look at the stuff and what's happening with AI. And then because of this, you'll have massive disruptions. You'll have chaotic marketplaces, and you'll also have, in a chaotic marketplace, you're going to have fear. You'll have panic and some hysteria. But once you've got your defenses set up properly, you can focus on the opportunities that are available in this environment, staying nice and calm and picking your spots. So that's kind of how I'm approaching it. I'm preparing for a very bumpy ride. I like bumpy rides. They're exciting. They're not boring than just a smooth sail, right? Mm-hmm. So I'm a realist. I look at what's happening and I can see there's a lot of clouds forming and there's some storms coming and it's going to be bumpy, but it'll be very exciting. And I also am a very firm believer in turning massive challenges and problems in opportunities. That's what business owners and investors do, right? So there's going to be many of them, which I'm very, very excited about.
Yeah, so in the vein of defense, like you said there, what would be some investment classes that you personally, in your opinion, would absolutely want to steer clear of?
Yeah, so I mean, I am not involved at all in the equity markets. So I'm staying away from the equity markets because it's so liquid. Although, you know, crypto is great and is a very innovative space, and there's still a lot of opportunity there. And by the way, you're still going to see some fireworks in that space. It's by no means dead. When you see that in the media, you know it's not dead when they tell you it's dead. You know, those are kind of two areas specifically that I'm staying a little bit clear of. I still do some dollar cost averaging into, you know, certain crypto, but I'm not making massive moves there, just enough that I'm comfortable riding out any volatility because there's going to be a lot. Liquid markets are the first markets that will be drawn down significantly when you see a bumpy ride, or you see markets start to, you know, pivot, and you see panic and fear starting to spread, and some hysteria.
Yeah, absolutely. No, I share your thoughts on that as well. What are you doing with real estate in 2023? You didn't mention that. Is that something, and I guess the second part of that question is, if those were the investment class to stay away from, conversely, where do you see the opportunity?
Yeah, no, there's going to be opportunities in real estate. You know, and people ask all the time, and I'm sure you get it too, but what's going to happen in real estate in 2023? And it's
only 10 times a day. Yeah.
Well, yeah, exactly. And I would, you know, respond and say, well, what market and what sub-market in that market? Because you can have one market and a sub-market in that market that is so good and have so much opportunity. And then another part of the country, it's going to get decimated, right? And we've seen that. We've seen that since 2020, where there's certain parts, especially in the United States, certain markets that have been main beneficiaries of all this chaos. And then there's certain markets that are just getting absolutely devastated. And they continue to be. So yeah, there's going to be huge opportunities around. And also another thing that I would add to that is, and this is where you're fantastic at it, is identifying who you are serving with your product that is real estate. I think when people just go, you know, across the board, kind of like blanket statement, you could get hurt if you know exactly it is who you are serving through your product of real estate. And especially if it's at the high end, I think that you're going to do very, very well in certain markets. You know, some of the short-term rental markets in very specific markets around the country, I think it's going to continue to do really well because things are going to continue to go well at the top end of the economic ladder. Unfortunately, in the middle of the ladder and the lower end of the ladder, there's going to be some very, very, very hard times. There's still going to be opportunities there, but there might not be as much as at the top end of the ladder. So I think you need to be very specific of who you're serving, and that's what I appreciate about you. You know exactly you're serving through your real estate investments, and who the product is providing value for. So when you do that and you kind of niche down on certain markets, because they're there, you're going to find a ton of opportunities. And then there might be some markets that you want to stay away from. And those would be markets with very, very unfavorable governance, regulations, taxes, you know, all the things that we don't like. So, yeah. And most of those folks anyway from those markets are moving to the markets where there are better governance, there are better regulations, and there are better tax environments.
Yeah, absolutely. And you really can't just paint real estate investing with such a broad stroke anymore. There's so many different classes within the real estate. To your point, the short-term rental, there's the long-term rentals. Obviously, there's, the fix and flip models. There's the wholesale model. There's creative finance models. There's a lot of ways to do real estate right now. Identifying your niche. So to your point, my company, Lavish Keys, we decided to go exclusively in the luxury space. And that was a decision we made out of the gate by design, because seeing what was coming with the economy, knowing that folks that didn't have that discretionary income on kind of the lower to middle income, they would not be a great demographic for us if the market were to continue to decline. But the people at the top of the market, the luxury travelers, if you will, are going to continue to have that discretionary income. They're going to have that travel and that vacation budget regardless of what's going on with the economy. So by design, that's where and why we planted our flag in that luxury space. That being said, even if you're not in the luxury space, you could have the same type of house, same property type, but in different markets. One's going to be blown and going. It's going to be continuing to appreciate. You could take that same house and put it somewhere else in the United States, and the thing is a dog with fleas. So that broad stroke does not apply right now. What we've always seen historically is when the market does go down and real estate does kind of plummet, if you will, or at least start to go down a little bit, it's going to start on the coasts. So if you are looking for deals, take a look at the coast. Those are going to get hit the first, and they're going to get hit the hardest. They will also rebound the fastest. So if you're getting those deals when the market does start to come back, they're going to be the first to start to rebound as well. So just some nuances involved in that. Obviously, we've all got our own recipes for success with real estate, but those are a couple of mine as well. Staying in that STR space, so there's been a Wall Street Journal article out recently, and kind of in this same vein, and it was called the AirbnBUST, I believe was the name of the article, and it was talking about folks that really tried to capitalize on the big STR boom over the last couple of years, really brought on or really exacerbated by the pandemic. And they were buying any house anywhere, and people were just trying to get out and move their legs and be mobile, and they weren't working at their offices anymore. So that work from home flexibility, and they were really leaning heavily on that short-term rental market. Now it's starting to normalize again. Now, markets that I participate in short-term rentals, like Disney, for example, that always are going to have that big-time tourism draw from all of the theme parks, period, and the warm weather down there. So we're still continuing to see high occupancy, high ADR there, but per that article, people are getting destroyed across the country that went out and bought those homes, and now that it's going back to pre-pandemic, booking levels, they're really getting their lunch handed to them. Any thoughts on that?
Yeah, in 2023, and 2024 and 2025 too, we as investors are going to be tested, and we're all going to have to raise our game, because it's not going to be as easy as it was. Not that it was ever easy, but I mean, we've had a very good run since 2012, I would argue, to 2022. So if you had bought at any given point in time there, you would have had some great upside potential and upside moves. And it's the same thing with the Airbnb kind of craze that happened, when the events of 2020 happened. I mean, Airbnbs just started to take off, and this has been an enormous opportunity. So a lot of people went into that. And if you were early, yeah, I mean, timing in life is critical. I would argue it's part of the success story is the timing of it, right? So if you were in early, you saw some of that upside and you rode the wave. But that doesn't necessarily just require skill. Yes, you can position yourself and catch a wave, but a lot of people just stormed into a market, right, and rode the wave up. Well, you're going to need the different skill set as an investor in all types of assets, and especially these types of asset classes and niches to do well. So yeah, you're going to have to raise your skill set, your capabilities, your knowledge, and the tougher environment, by the way, that is here. It's not coming. It's here. Is going to force us all to become better investors. So people are going to be tested. So yeah, but to your point that you made earlier, to brush real estate with one broad stroke is not really fair. The same with Airbnb. While the majority of the market is getting decimated, there's a small niche that's not, and there's investors that are not. Then they're actually doing better than ever. It's fascinating how it works out in every single market that I've been a participant in, and just observe that when there's a bubble that pop and a bust, essentially, what this is, the majority of folks get flushed out and get really hurt, and a small group of folks always seem to just keep crushing it in those markets. I'll give you an example. We just talked about the Airbnb example, right? Where the majority of the market has been just smacked, but a small group of folks are doing extremely well. We saw this, by the way, about a year ago in crypto. So I don't think folks remember this, but right up into the run to the Super Bowl in 2022, crypto was plugging along nicely. And it was sort of the coming out moment, as like this thing at the Super Bowl for crypto, because the majority of ads were geared towards crypto, right?
And some of the players that were playing in the game were some of the spokesmen for that particular token. Yeah, I remember that.
Yeah, absolutely. And you had, crypto.com and FTX, and who would ever forget the funny ads that Larry David, one of the creators and writers of Seinfeld, was in. So at that very moment when that happened, a lot of professionals in that space said, well, this is the top. This is, this is it. You got Matt Damon on ads. You've got Larry David promoting crypto. You have Tom Brady. You've got professionals. You've got celebrities, influencers. If this isn't a top, what is a top, right? So that was a very painful lesson for a lot of people in crypto, because at that moment where this kind of went mainstream and it got like a lot of attention at the Super Bowl, the professionals were getting out as the public came in for that final little run up, and then all of a sudden there was a rug pull. So it's fascinating. I mean, that's why I love this game so much. I love the investment game, because history doesn't necessarily repeat itself, but it sure does rhyme, that Mark Twain said. And you could see it, in different asset classes and different investments and different cycles. It's kind of the same themes repeating itself over and over.
Yeah, absolutely. Absolutely. I would be remiss if I had you on a video and we didn't talk about inflation and interest rates, mortgage rates. What are your thoughts on those right now? Has the Fed gone too far? Let's go ahead and start there.
Yeah, I think like most of the central banks, and here in the United States, we have the Federal Reserve. So what essentially happened is inflation got a very big head start in a 100-meter sprint. Let's just say 20 yards, right? And now all of a sudden, they were trying to raise rates to catch up with inflation. Now, are they going to catch up with it? There's a lot of arguments for and against. One of the reasons I think that they so aggressively raised the rates was to slow down demand. Because if you can essentially kill the demand side of an economy, well, that'll simmer and slow down inflation. So it's interesting to see this kind of tug of war that's happening, because anybody that's gone to the grocery store knows that inflation is rampant. Anybody that's, just living right now, not just in the United States, but everywhere else, sees the prices. And yes, there are many other factors besides the interest rates. One of the factors here in the United States, if you just try to buy eggs, for example, right now, at the time of recording,
$4 a dozen, just as of time of recording today. Yeah.
So you've had the avian bird flu, which is another variable to throw in there. But there was already massive and rampant inflation. The price of eggs looks like a crypto chart before the spike. So there are other contributing factors to it. I'm very, very aware of that. There's a lot of variables. Of course, the war that's still going on in the Ukraine and so forth. But big picture wise, if I have to look at it and say it's a tug of war, I think they try to kill the demand side with the raising of the rates so aggressively. We'll see where this ends. If they if they stop raising the rates, I don't think they catch inflation. If they keep raising it, you might destroy all of the demand in the economy, and then you see the economy worsening further. So it's like you're really stuck between a rock and a hard place here. It's going to be interesting to see how this plays out.
Yeah, I'm certainly curious myself. I've got a lot of folks, obviously, that are, in the real estate game, realtors especially, they're scratching their heads. They're the ones that last year at this time, obviously, were, doing backflips, and now it's a head scratcher for them. Again, I think part of it is also kind of trimming the fat. We talked about STRs, trimming the fat in that industry, in that specific investment class is going to weed out the houses that are less than desirable. Same thing in the real estate game. It happened after 2008. The cream rises to the top. The people that are not the top producers, as real estate agents, they're going to fizzle out in the next couple of years. So that is another reset in that industry that I think is going to be among us here in pretty short order as well. What are you saying to investors right now that you're talking to that are either in your camp or you're mentoring in some capacity that want to get involved in real estate investing or have been, and now they're pumping the brakes? They want to sit on the sidelines and kind of see what happens. What do you tell them?
Yeah, I mean, Warren Buffett always said doing nothing is also doing something. So observation can be good, but there's opportunities there. Don't force anything right now. You're going to have to be smarter. You're going to have to be very strategic, and you're going to have to pick your spots. It's not that time, as you like to say, to get fancy. You're
no time to be cute. No time to be cute.
It's not a time to be cute at all. So yeah, I mean, don't force anything. Don't, because I see a lot of people, they're very anxious to do it. And I said, you just have to sit tight until it makes sense. The numbers make sense. And the deal makes sense. Then you move forward on it, but you don't have to force anything right now. That's the nice thing is, it's a good situation to be in if you have some capital, you have some liquidity set aside, which we've encouraged people to do, because you can be an observer and then jump in until it makes sense.
Yeah, I agree with that. Obviously, go in with caution, obviously doing your due diligence. But as an investor, I'm active right now. And to your point, there are deals to be had. So I know a couple things. I know that I can always go back and fix a mortgage rate, but I also know that I can't go back and fix the sale price of a home. So if I'm waiting on the sidelines for those mortgage rates to go down, call it 2%, but at that same time, that same property appreciates 5%, then I've lost that game, right? So I can always go back in and fix a mortgage rate. If I'm analyzing a deal right now, as it stands today with market conditions, with mortgage rates, with price of the home, all of these ingredients baked into it, if there is meat, good meat on the bone today, that's a high enough of a yield to warrant me to deploy my capital, knowing that the deal is only going to get better if I do, a refinance, for example, when rates come back down and I can get that additional, 2-point savings and 100% of that's going to convert down to my net bottom line cash flow position, then I'm doing the deal today. Because if it looks good today and I know it's going to even look better in a year or two, why wouldn't I move forward? So, I hear you. I do subscribe to, that wait and see approach to a certain extent. Don't try and force a square peg into a round hole for sure. But if there's meat on the bone, take these deals down, guys. Competition is going to be less right now, so odds are you're not going to be overpaying. People that are in the market are going to be able to capitalize on these deals. It sounds like you kind of see things the same way, MC. So, guys, following the data, and you mentioned that it's a math problem. If you can follow the data, let data drive the decision and take all emotion out of it, 9 times out of 10, you're going to win with that. If you follow the math, you follow the data, you're more often than not going to come out on top.
Yeah, and I would say, and we've talked about this before on this channel, I kind of have an hypothesis of how things are going to play out from a big picture standpoint over the next couple of years. And unfortunately, I mean, the trends that are in motion aren't pretty. They're there. There's nothing I can do about it, but I can position myself for those trends. So one of the things that I've shared is I kind of see a Hunger Games society kind of evolving and happening. And it's happening in real time. So that's why it's very important to understand at which end of the market you're at, because there's going to be opportunities in all different types of markets in that Hunger Games society. But especially at the capital, there's going to be a lot of them, right? So to your point with like the luxury short-term rental space right now, I mean, there's so much demand for that. So yeah, if there's deals that make sense from the data that you can unemotionally just look at this, yeah, I mean, the competition is going to be so much less because people are fearful. Yeah, I mean, that would be a great time. But then just look at the big picture and the trends unfolding and turn those trends into opportunities. There's a lot of opportunities. You're going to have to make some tweaks in your business plan from time to time. I try to be flexible and nimble. You know, the most adaptive and the most flexible of the species survive, right? Yep. Any environment. So don't be like the dinosaurs. You got to be flexible and you got to be adaptive when the market changes. So you got to give yourself some opportunity to make some pivots if you need to.
Yeah, and one of the greatest tools that you utilize and that you really work with our folks on this channel and obviously folks across the world on is the whole life insurance policy and implementing the infinite banking concept. We're not going to dive into it on this video too deeply, but we'll go ahead and drop that playlist for those of you that are watching that have not seen that. Highly recommend you taking a look at that. It's a phenomenal investment vehicle, particularly for volatile times like we're in right now. If you want more information about wealth strategies from MC and his team, or you have an interest in the whole life and the infinite banking concept, go ahead and email ninja@vipfinancialeducation.com. Include your first, your last name, and the best number to reach you in the body of the email, and Cashflow Ninja Conversation in the subject line, and someone from MC or his team will get back to you ASAP. MC, I know your time is valuable. We appreciate you coming on here. We'd like to bring you back on here in the next couple months and get updates from you. You've got great insight. Our audience always appreciates that. Guys, be sure to go out there and do your own due diligence. If you're not a subscriber, please subscribe below. Ding that bell notification. That'll give you alerts as we continue to put these videos out here. We've got several that are coming out every single week that are going to be relevant in today's economic turmoil. Until next time, take care and make it a great day.